Hey guys, Richard Matthews with Matthews Wealth Management. Today we're going to be covering modern portfolio theory, and that's what we use to invest our clients' assets here at Matthews Wealth Management. So we're going to break down exactly what that modern portfolio theory is and diversification, asset classes, etc. So we're going to avoid talking about the underlying securities and what we're picking there, but kind of what makes it work and how it manifests itself statistically. So modern portfolio theory was actually an idea that was developed by a Nobel Prize winning economist. His name is Harry Markowitz. And what happened was he came over from Germany in 1946, which if you kind of do the math was post-World War II. And he was an economist that studied how economic indicators and market pricing were correlated. So he could find out how different asset classes would relate with each other depending on what's happening in the underlying economy. So what that basically means is that if we take a portfolio, and everybody's familiar here with the concept of the pie chart, but if we take a portfolio here and we've got a percentage here that's going to be split into, let's say, large cap stocks. Another area, maybe we have some mid caps and some small caps. Over here we have some high grade bonds. And let's say the last portion, we've got some cash and real estate. So if this is a hypothetical portfolio of different asset classes, the way we work at Matthews Wealth Management is that we plot out exactly what targeted rate of return we need to generate to make sure that our clients hit their stated goals, whether that's retirement or college planning or just cash management inside of their business. We have a targeted rate of return. So what we find in modern portfolio theory is that, let's say our target here in this instance is a 7.2% year after year rate of return. So the chances of us hitting this targeted rate of return year after year after year include a number of factors. Okay, so the first thing we're going to look at is strictly our asset allocation. How much do we have in the big companies, the small companies, the bonds, real estate, cash? Because these percentages and how they react to each other in the economy and in the market pricing will dictate what rate of return comes out, and also how reliable or how many times we can repeat that targeted rate of return. So what Markowitz found was that 92% of your efficiency of hitting your targeted rate of return comes solely from having the right percentages in these different asset classes. We're going to break down asset classes in a bit, but this is overwhelmingly the most important part of generating a portfolio for a stated rate of return. The next area that will affect our reliability, we have a 6% piece of the puzzle that actually breaks down to our underlying investments. Did we pick Coca-Cola or did we go with Pepsi? Did we do Home Depot or Lowe's or Harley Davidson or whatever the competitors are? It does matter. Having the right pick inside of these asset classes does make up 6%. So we do spend a good amount of time doing research on different holdings to make sure that we're taking advantage of efficiencies in there. But again, overwhelmingly, we're looking at 92% efficiency just based on what's called asset allocation. The remaining 2% here is going to be market timing. We're in an interesting time right now where the market is down due to the COVID-19 shutdowns, but this timing situation is 100% luck. There's no way to know what's going to happen tomorrow. There's no way to know what the Federal Reserve is going to do, or whether Congress passes some new tax, or whether a war breaks out in the Middle East. So if anybody tells you that they can predict this last 2%, just run. It's not something that we spend too much time on here, because the other 98%, if we can have a systematized way to incorporate our asset allocation and picking good underlying funds, we're most likely to get our targeted rate of return year over year over year. Okay, so that's the first step of modern portfolio theory. The next section that I want to cover is, let's say we go ahead and we invest our allocation in the right funds this exact way for our targeted return. And let's say about, 9, 10, 11 months later, we come back and we say, what does this look like now? Because we know that these different markets, the bond markets, the real estate markets, the money markets, the stock markets, they're all going to do their ups and downs, right? And they're not necessarily going to go in the same direction. In fact, most of the time they go in different directions or they're non-correlated. But let's say we take a look at our portfolio down the line, and half of it now is high grade bonds. Bonds had a good year. Stocks probably had a bad year. So we're going to say that this is our large caps. Then we're going to say, okay, we've got some mid, some small caps, and then cash and real estate. So in that case, real estate and cash didn't do too much. They look basically the same as they started. Large caps shrunk, mid and small caps shrunk, and high grade was by far the best asset class of that year. What would you do in this situation when you look at your portfolio and you see the biggest gains have been in bonds and the biggest losses have been in stocks? Well, what most people do with their 401k is they'll look at what the performance was for the last year, last 3 years, last 5 years on their statement, and they'll buy more of it. So in this case, we would sell off our stocks because they did poorly, and we would buy more of the bonds. That's exactly the wrong thing to do. So what we're actually going to do is we're going to say half of this bonds, all of those gains, we're going to sell them. And we're going to turn around and we're going to buy the things that lost the most. This is the oldest trick in the book. We are selling high and we are buying low. And we are going right back to what we started with, because next year we have a 98% probability of hitting our targeted rate of return with this allocation. So this is what we call rebalancing. We don't want to be in this kind of portfolio because who knows what we have a 98% chance of hitting year after year. In fact, there's probably a ton of inefficiency here. So this is the concept of modern portfolio theory and how to employ the asset allocation models to make sure that you have the best chance year after year after year of hitting that targeted rate of return. We're going to come back and talk a little bit more about asset classes and what those actually mean so that we can have an understanding of how they fit into a portfolio. All right, we're back. We're talking modern portfolio theory, and specifically now we're going to get into the asset allocation part of modern portfolio theory, and I really want to cover what are these asset classes. So when you hear things like mid-cap value and small-cap growth, what exactly are we talking about here? So if we're talking about caps, we're referring to companies and equities. They're interchangeable. Equities is a fancy word of saying stocks. So if you're going to break down how these companies get sorted in terms of their asset classes, there are a number of different factors that we're going to cover here real quick. So the first thing that we're going to say is capitalization is really a measure of the size of the company. So if you were to look at adding up all of the value of all of the shares of stock, we would have a capitalization number, and that's what starts to sort the types of companies that we would invest into. So the first area that we're going to cover is companies that are over $10 billion. And this is what we refer to as large cap or large capitalization. So I'm going to put LC there. The next area is anything that is between 2 billion and 10 billion. And that is mid cap. And as you could probably figure out, anything that is under 2 billion is what we're going to call small cap. Now you can really get into the minutia, into the weeds here if you get into micro caps, etc. But let's just go with large, mid, and small. Well, the next thing we're going to talk about is what types of companies are we investing into, is in terms of what is their business model, what is their product, what is their revenue driven by, and so we have 3 different ways to look at the types of companies and categories here. So the first one we're going to talk about is value. Value investments include things that typically pay higher dividends, they're a little bit safer if there's a market decline, They don't grow as much. They're in the cash cow phase of their business model. The next area we're going to look at is core. Sometimes interchangeably you could call it blend. This gets to be a little bit on the awkward side of how do you determine something as value or core, but the last area that we're going to cover is growth. So growth stocks typically are either tech-based or R&D or coming out with the next new thing. So let's kind of go through specifically and see what are some examples in each of these capitalizations and overall types of asset classes. So the first upper left part of our box is what we're going to call large cap value. So a great example of that would be GE, AT&T, Duke Energy, that kind of stuff. Now let's talk about the large cap core, and an example of that might be AutoZone, eBay, International Paper. There are all these different types of large cap core, and it gets a little bit shaky, like I said, if you're really going to have these hard and fast lines between value, core, and growth. The last area that we're going to look at is large cap growth, which is very easy to pick out. That would be Facebook, you've got Netflix, Google, Apple. Like I said, a lot of tech companies fit, or Alphabet I should say now, in this large cap growth part of it. So next, let's cover some mid-cap values here. A great example would be American Airlines, First Solar, and let's say Halliburton. That's another good example of mid-cap value. The dead center part of our square here is going to be our mid-cap core, and here we're at Ally Financial. We could put International Paper here. DR Horton is a good example. But that kind of gives you an idea of the types of companies we would consider mid-cap core. And lastly, we'll go mid-cap growth. Here's a new one. We can go Beyond Meat. If you like those Impossible Whoppers, I'm not a super big fan. Dropbox, GoDaddy, that kind of stuff works for mid-cap growth. So lastly, let's talk about some small companies. On the value side here, we would have American Eagle. We could do Blue Apron. It's kind of an interesting one. You would think that Blue Apron might be growth since they're new and startup here, but that's a good example of a small cap value company. Small cap core, Lazy Boy. That's a good example. And then we could say Mattel. Mattel making games and toys and so forth. Small cap growth, the last area, let's go with Federal Signal and Floors and Decor. My wife made me buy that for her Roth IRA. So that gives you a little bit of an idea of the asset classes for equities. So we're talking about stocks, we're talking about companies based on the size and also the type of what their business looks like. So we'll come back and hit a couple of more asset classes real quick and talk about the bonds. All right, we're back. We got rid of the equities. Now we're going to talk a little bit about bonds. There are different ways that we evaluate bonds, and it's pretty straightforward. So we've got the same layout here as we did for the stocks, but now we're going to talk about different types of bonds. So bonds are nothing more than loans. So you would loan your money to a company, a government, whoever you're loaning your money to in exchange for interest to come back. So let's look at different ways that we could classify the loans or the bonds that we were to purchase. So the first area we're going to look at is what we would call high grade. The highest grade bond you could get right now would be from the U.S. Treasury. So government bonds is typically what we're going to refer to. There are different ways of looking at international government bonds, buying from Chile or Austria or wherever you're buying your international bonds, they may not be considered high grade. So when we're talking about grading bonds, it really has to do with the ability of the borrower to pay back not only the interest, but also the principal over a period of time. So high grade are going to be pretty much a sure thing. So they pay a little bit lower interest rate than when you get into these other grades, but these are the tried and true safest way to invest in bonds. The next area we're going to look at would be investment grade. Investment grade gets kind of in mixed because now we're talking about different types of governments, municipalities maybe if you were investing in a local bond, but you also have corporate bonds that start to come into play. So if you were going to loan some money to Google, for example, so that they can increase their data storage center and they're going to pay you a 5% interest rate for your money over a period of time, that might be an example of an investment grade corporate bond. So we've got the high grade, investment grade, and then the last thing we're going to talk about is high yield. So high yield bonds, typically they're a lot riskier. That's why they pay a higher yield or a higher interest rate on the underlying bonds. But these are the three levels in terms of ability to repay the loan. The next thing we're going to talk about are the columns on our layout here. What we're talking about in this is the term of the bond. So the longer you loan your money out to somebody, typically you should get paid a higher interest rate because there's more of a risk of you not getting your money back. So here we're going to say short-term bonds, and that might be like a 1 to 3 year term on a short-term bond. Then we're going to get into intermediate term, and we can say 3 to 10 years would be an intermediate term to loan your money. And then you got your long term, and we'll say 10 plus here. So, so if we're looking at the overall picture here, long-term 30-year treasuries that you would get from the U.S. Treasury would fall in this box up here. High grade on the intermediate term might be a 10-year treasury. That's a very important number when we're looking at overall yield on a portfolio to compare to a 10-year treasury. Short-term treasury, as a matter of fact, recently here we've had some negative yields in our 3-week and 4-week T-bills. So that's been interesting. And as you're investing into different corporate bonds or investment grade corporates or municipals, there's a tendency sometimes to see these get downgraded. So when you hear about bonds or the S&P or Moody's downgrading, bonds can move all over the place in here. But by having all of these types of bonds itemized in terms of an asset class, we can really control how we're loaning money or the types of loans that we're buying on a secondary market. So we're going to come back and hit the very last part of asset classes and wrap up the modern portfolio theory. All right, hey guys, we're back. We're going to wrap up modern portfolio theory specifically on the asset allocation and cover a couple of more asset classes that we need to factor into modern portfolio theory. So we hit the equities and the stocks, we hit the bonds, the debt, and now we're going to talk about some other asset classes that aren't so linked when it comes to correlations. So one area I want to look at is real estate. Real estate is actually a mix of asset classes all mixed in with each other. So you have just residential real estate that I'm sure a lot of people out there understand how to invest, buy land, buy houses, flip houses, rent things out, etc. But we also have different things like how to buy real estate for commercial. Sometimes you can buy a loan on commercial debt that's out there where you're buying mezzanine, where it's different types of debt that maybe Delta Airlines or Ace Hardware is paying to a big building in Chicago, and you can get a portion of the revenue that's being generated on the real estate from a company. So data and infrastructure storage, a lot of these data centers for Google and Amazon out there, you can partake in getting some of the revenue there. REITs are another opportunity of real estate. There are just a lot of different ways to invest in real estate. So we want to have that as a portion of our overall portfolio. So whether it's physical properties or whether it's owning shares of different trusts and so forth, real estate is pretty vast, but it should represent a portion of pretty much any portfolio with a targeted rate of return. Another thing we want to look at, especially lately, is going to be commodities. Commodities, typically when you hear that, it sounds like gold, silver, and those precious metals do make up a pretty good portion of what we deem commodities, but also timber and cattle and sugar, pork bellies. I like to make bacon, so I follow pork belly futures pretty closely. But commodities include a lot more than just the currency-backed precious metals piece of it. Oil lately has been interesting as well, but commodities should be making up a portion of a portfolio. If nothing else, you have a hedging of future costs and inflation built into commodities. Venture capital. This is when you're getting into a lot more on the speculative side of investing, looking for opportunities for new businesses where you can really have big multipliers of your investment, high risk, high return type stuff. And a lot of these are reserved for accredited investors. So this is something that does fit with a number of our clients here to look for those opportunities in venture capital. Cash is another example of an asset class. Cash is not always just the green stuff that's in your wallet or showing up on a checking account. We have money markets, we have short-term bank loans, we have commercial paper. There's a lot of ways to manage cash to get the right amount of yield and interest above just nominal CD rates. So this basically a quick synopsis of some additional asset classes. You can do a lot of research on asset classes and see that very easily you can get to 27 asset classes, and if you really want to dive into it and break them all up, I've seen it go as high as 96. So depending on how narrow of a vision you want to take at having the right allocation of asset classes is completely up to the investment professional. We tend to work in the 27 range, but yeah, just to kind of give you an overview of what it is that allows you to target each of these asset classes is really what will have the outcome for the predictable year-over-year rate of return that should be targeted to your investment goals. So hopefully this has been helpful. We'll continue to do some more videos based on how do we pick the underlying investments, how do we target each of these asset classes, and how do we make sure that we're implementing modern portfolio theory in a standardized process over time. So thanks for joining us. We'll see you next time.